Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm happy to be joined again by Chris Grisanti, MAI's Chief Equity Strategist, for his current perspective on where we are in the equity market and what's been a surprising but welcomed rebound for equities so far in 2023. Chris, thanks so much for joining me today.
John, it's always good to be with you.
Well, Chris, we're a little more than halfway through the year now, and I'm not sure there were too many forecasters that were predicting this strong of a market in 2023. But we have seen the economic data remain fairly solid. Earnings haven't been great, but they've been okay. And I think more investors are starting to discount the likelihood of a soft landing in the economy, despite the Fed's battle against inflation. So, Chris, why don't we start off with just your current perspective on the equity markets? Are you content with where they are today?
John, I'm a value investor, so I'm never content. I think that's part of our DNA. But of course, as an equity analyst, I'm happy that the market is up. The mood is obviously much better than it was 6 months ago. And the end of 2022, it was a tough year. Having said that, there are some things internally in the current market that I think investors should at least be aware of because they're not normal. At the end of June, so the end of the first half, the S&P was up about 16%, which is terrific. But if you take the biggest 7 stocks out, the other 493 stocks were up only 4.5%. And the stocks that led the way, those 7, were mostly large technology issues. And in many portfolios, including the value portfolios that we manage at MAI, those stocks are difficult to purchase because they're so expensive. That'd be like Nvidia and Tesla. And those stocks were up each over 100%. So I think we need to see a broadening of the market and away from those super expensive stocks. And I'm hopeful in the second half we will see that.
Yeah, that's a good point, Chris, because when you see the headline numbers, you think the whole market is up just as much as these top companies, and it just hasn't been the case. But to your point about the market, starting to broaden out, do you think the recent momentum is enough to see that start to happen going forward? What are you expecting?
Well, that's where things get interesting, John. And I think in the short term, it is enough. I think that the extreme movements of these 7 stocks will be balanced by a broadening of the market. Now, but I'm more concerned about what I see kind of longer term, out 6 months, 12 months. A number of analysts are saying that we've entered what they're calling a Goldilocks market, which is neither too hot nor too cold, and of course inflation is coming down. But investors should remember when the Fed hikes rates, both the folks that are optimistic and pessimistic, almost everyone agrees that inflation will come down. That's not the problem. The problem will be, will it bring the economy down with it? And to look at that question a little more closely, I have what I think is the most important chart of this particular moment in time, if we can put that up on the screen. What you can see from that chart is a bunch of colored lines, but they represent the 6 interest rate hike cycles that we've been through in the last 40 years. And of course, the red one is the current one. And the thing that sticks out about that line, literally, is that it's sharply upwards. It's more steep than any of the other lines, and it's also higher than any of the other lines. So the current interest rate hike has been both the fastest and the highest that we've had in more than 40 years. Okay, so that's fact number 1. Fact number 2 is if you take the other 5 lines on that chart, and look, those are the last interest rate hikes, all of them except one, the one from 94 and 95, were followed by a recession within 2 years, sometimes much quicker. So in order for you to be comfortable that we're going to have a sustained soft landing, you have to think that the highest and fastest interest rate hikes in 40 years will buck the trend of usually a recession happens after such interest rate hikes. So Now that may be true. It may be different this time, but in my career in Wall Street, that's always a tough bet to make. So I think it's more prudent to think, wow, there's a lot of momentum right now, and the market's enjoying it. But boy, these interest rate hikes will probably eventually take hold, and things will get much more difficult.
Well, certainly a sobering tone in what's been, a great year for investors so far. But as you think about what that means for investors in equities, with that kind of an outlook, should they be running for the hills?
No, no, absolutely not. And I certainly don't want to leave the impression that this is a panic moment, or it's just there, as the Bible says, there's time to reap and there's time to sow. And I think this is a time to maybe sail a little closer to shore. But I wouldn't head for the hills for three reasons. First, I might be wrong. You remember, it happened 4 out of 5 times, but the fifth time it didn't happen. It was a lovely soft landing, and the market took off. So it's entirely possible that a recession might not happen. Although I think the historical odds are against that. The second reason, even if there is a recession coming, the timing is a big issue. What happens if the recession doesn't start for 2 years after the final Fed hike, which, by the way, I think is going to happen sometime this summer. So that might be out in 2025. You could miss a very strong 18 months of the market by heading for the hills right now. But finally, and this is the most important point, there are always bargains out there. Even if the economy is about to slow, there are some stocks that have already discounted that slowing. There are some stocks, I think particularly about healthcare stocks, for example, that won't particularly suffer if the economy slows down. So there are ways to uh, structure the portfolio to compensate for what I see as an economic slowdown. Now, we don't forecast, we don't market time, but we do think, what does the future hold and what's prudent for your investments at this point in the cycle? Again, we can't time the market. We don't know when it's going to go up or when it's going to go down. But there are times when the economy seems more likely to slow or more likely to speed up. And I think it's more the former now over the next year or so.
Interesting. Well, good advice, Chris. And I think it aligns well with the way that we think about long-term investing at MAI, because we really are focused on constructing portfolios that are built to last through market and economic cycles, and not try to pin our clients' financial future on a single forecast or prediction that may or may not come to fruition. This sometimes can sound like a lack of conviction, but what it really is a product of observing the markets over the past century, and just the folly of trying to time the market around cycles, and the wisdom of staying diversified and staying invested in order to compound returns as the economy grows over time and companies find ways to innovate and grow. It's a great reminder as to why we are so focused on building portfolios that can withstand the good years and the bad, and secondarily, try to tilt portfolios in the direction of where we see the most attractive risk-reward opportunities in the market. As always, we're appreciative of the opportunity to partner with you in this important aspect of your life. And we'd encourage you to reach out to your wealth manager with any questions specific to your portfolio. We thank you for listening. Thank you for Chris for joining me today, and we'll see you next time.